Deferred consideration, as the term suggests, means a mechanism where the buyer acquires the entire shares of a target company from the sellers but pays a part of the consideration subsequently either at the end of a defined timeline or upon completion of certain milestones or targets. Deferred considerations can either be structured as a fixed payout at the end of a defined timeline or as an earn-out where the consideration is linked to certain performance metrics like achievement of financial performance for the target, EBITDA achievements, or simply certain business milestones like maintaining customer contracts or sales revenue targets. Deferred consideration mechanism has become an important aspect in bridging gaps in valuation expectations between a buyer and a seller and enables sellers and buyers to reach a mutual goal towards achieving a sales milestone and performance goals for a target even after closing. An important aspect for buyers is to decide if they want to keep the sellers or promoters engaged in the company post-closing, and if so, in what capacity. This decision will influence the deferred consideration terms and ensure the buyer's payment terms align with the seller's expectation of business values. Some key benefits for sellers in a deferred consideration mechanism is that it would help sellers negotiate higher price for payouts based on the post-acquisition financial performance and success of the target. It would allow sellers to maximize their payout, which would be tied to the company's success, and keep them invested in the business during this entire integration phase. Whereas for the buyer, deferred consideration will ease the upfront cash outflow. It will to a large extent mitigate related financial projections made by the sellers for historic performance of the company, offer a safeguard for any indemnity claim which may come about during this defined time period, and also ensure that the seller still remains in the game to ensure business continuity for a period of time. One of the key aspects for deferred considerations being successful is ensuring clear and robust clauses being implemented and drafted into the share purchase agreement. The performance matrix must be clearly defined in the agreements to determine deferred payments. These payments can be in the form of earn-outs, milestone payments, or contingent payments based on specific achievements. The mode of payment of the deferred consideration should be carefully designed to balance the interests of both parties. The payment schedule and timeline should be clearly defined to avoid any ambiguity and potential conflicts or any litigation. Deferred consideration clauses must be precisely drafted. Important aspects here include illustrations to indicate calculation and methodology for determining deferred consideration. It should clearly set out the accounting principles on which the calculations are based. Also, an important aspect is to set out the assumptions for the calculations of the key financial performance. The clauses should also articulate both the seller and buyer's expectations and obligations on how the business would be conducted during the deferred consideration period. It is also important to provide a very suitable and adequate resolution process in case of any dispute or difference in determining such deferred consideration. Seller's primary concern in any deferred consideration mechanism would be the certainty of payment, especially because they are not in control of the business post-acquisition. Adequate safeguards for sellers should ensure that the buyers do not alter key business metrics adversely post-acquisition. For example, provisions should restrict buyers from transferring any crucial key asset of the business or diverting business into good companies. Whereas for the buyer, the worry is more in terms of the sellers fulfilling their obligations post-closing, and thus the sellers might need to stay invested in the business for an undefined period of time. Accordingly, the agreement should capture consequences in case a seller considers an early departure, which may include downward adjustments for deferred consideration. Another important aspect to be kept in mind when a buyer is non-resident and a seller is a resident Indian is foreign exchange implications on deferred consideration. The applicable foreign exchange regulations in India permit only 25% of the total consideration to be deferred that too for a period of 18 months from the signing of the share purchase agreement. It is important to keep in mind here that the trigger is from the signing of the share purchase agreement and not the closing of the actual share transfer. Please also seek adequate tax advice to navigate any capital gains implications on deferred consideration.